Hello, everybody. Welcome everybody to today's session, Inside the Mind of Investors. We've got an incredible panel lined up for you. We've still got some people joining us as we speak, but we'll crack on because we've got a lot of questions we want to get through. And you don't want to hear from me; you want to hear from the incredible lineup of investors we've got. So while I keep admitting people, I'll just do the quick introduction to Robot Mascot for those of you who are new to us. So I'm James Church. I'm the author of the best-selling book, Investable Entrepreneur, also the co-founder and COO here at Robot Mascot. And we create investment materials that convince investors, business plans, projections, pitch assets, business valuations. We create all of those materials that you need to convince investors. And when we do that, our clients are 30 times more likely to raise the investment that they need. This has led us to being recognised as the UK's leading pitch agency, trusted by the likes of Crowdcube, Seeders, Dent Global, and a number of others as well. And ultimately, we believe that the powerful things happen when great innovation meets inspiring communication. It has the power to change the world, inspire movements, build brilliant brands. And we really just want to put an end to great ideas failing because of poor communication. Before we jump into the session, I just want to say a massive thank you to those of you who have purchased a ticket for good for today's session. It's allowed us to help entrepreneurs in Kenya, female entrepreneurs in Kenya, to build a business to support their families, draw them out of poverty, all through the power of entrepreneurship. And those of you who bought a ticket for good today, this is the impact that you've had just from today's session. So we've been able to provide 91 days of business training and microfinance to women in Kenya, 260 days of early childhood education, and 4,745 days of life-saving clean water to children in Africa as well. So a massive impact just from today's session. So a massive thank you. It's the most tickets for good we've ever sold at one of these events. So a massive thank you to our incredible community for doing that and allowing us to make this amazing impact today. As I said, there's a book out there all about investment. If you want to take a look at it, I won't go into that. And if you are thinking about raising investment, feel free to take our Pitch Ready scorecard at pitchready.co.uk. You'll get a free 12-page report benchmarking your ability to raise investment, and it will help you realize the areas that you need to focus on, and perhaps some light will be shed from today's questions as well. And finally, before we get to meet our investors for today, if you want to get the recording, you might want to connect with me on LinkedIn. I'll be sharing it in my Facebook group, Investable Entrepreneur, and you can access it on the Robot Mascot YouTube channel as well. So without further ado, I'd like to introduce you to our incredible lineup that we've got with us today. In a moment, I'll ask them all to introduce themselves. But before I do, I want to raise something very important. As many of you have probably noticed, we don't actually have any female investors today on the panel. It's all white men. And that's a massive issue in funding, the lack of diversity. And we want to really be active in making sure that there is a representation, a diverse representation on the panels that we do and the events that we do, and with the investors, the founders that we help. So we're always doing our best to try and showcase diversity through these events. But on this occasion, the two female investors we did have committed had to drop out for various reasons just before, the week before we were due to start promoting this event. So I just in a mass panic, contacted everyone in my network, and it was these incredible guys that came back to me and said that they were available short notice to be part of this panel. So that's the reason there's no females with us today. So I hope you can forgive us, but I do have two female investors lined up for the next version of this event that we'll be doing in a few months' time. So yeah, sorry that there's not the diverse panel that we'd expect of ourselves on this event, but hopefully you can forgive us. So with that said, I'd love to start introducing you to the panel. So Horia, would you be able to give yourself a quick introduction to the room?
Of course, happy to. Thanks a lot, James. So I'm Horia, originally from Romania. I've been in the VC industry for around 2 years, and I'm part of the Global Founders Capital team which is a City Growth fund. We have around 1.5 billion assets under management and quite a global team. So we have 15 offices across the world. And I'm mostly focusing on the consumer SaaS and gaming investments over the UK team. Yeah, that's a bit about me.
Fantastic, thank you, Horia. James, I'll come to you next.
Thanks, James. So I'm James Pringle. I'm a partner at Love Ventures. We're a small fund just launched, and we invest in fintech, prop tech, and consumer tech. Before becoming a partner at Love Ventures, I ran a big angel network called Pringle Capital, which still invests. And before that, I was a founder at Suggestive, which was acquired in 2019.
Fantastic, thank you, James. Daniel Gill, we'll have you next.
I'm Dan. I'm an angel investor and founder of a company called Orgnet. Before doing the angel investing in Orgnet, I was at Skype. I was a relatively early employee at Skype. I was there for just over 10 years, managing the telephony side of the business. On the angel investing side, I tend to focus on companies that have network effect as a core part of their growth plans. Yeah, typically that's SaaS models. And yeah, haven't been sort of so active in the last few months, but yeah, looking to change that throughout 2021.
Fantastic. And finally, we've got Doran with us.
Hi, yeah, so my name is Doran. I'm a partner at Ventures, which has been around for about 2 years now. Prior to that, I've been managing our family office portfolio in the venture capital sector. Ventures primarily focuses on fintech, artificial intelligence, and prop tech. But we are industry agnostic, and we tend to invest in pre-seed up to Series A.
Fantastic. Well, welcome to you all, and thank you for joining us and sharing your insights with our incredible audience, our community of founders who are all looking for little nuggets of information that's going to give them the competitive edge when it comes to seeking investment. So I'm going to kick things off, and I'm going to ask the questions that were submitted by the audience before as part of their ticket registration. So I've selected some of the most interesting and also some of the questions that came up the most. So hopefully it will cover everything that people want to know today. So the first one's from Pippa. And Pippa asks, given that you get many approaches for investment, what's the best way founders can get your attention? So let's start with Horia. How can founders best get your attention when they approach you?
Well, obviously, I think what comes to mind to a lot of people is trying to get introductions. But I'm the platform where the way I'm most fan of is just a direct thing, whether it's my email, my Twitter, or just on LinkedIn. And I think the key here is to keep the message to be very short and have something that's catchy in it. I think that kind of creates a sort of environment where you get to the point and you kind of spark the interest of somebody as to why would it be interesting to speak. And doing a bit of research beforehand into the investments that we did, or generally a bit of a research, so it shows that you're putting a sort of a personalized care into the message can be a springboard to do that. So I would say the direct approach is always the best, rather than just trying to really think or put your own hold on how to reach out in the best way.
So a direct approach with a personalized kind of researched angle. I know you've invested in similar businesses.
And brief, I would say.
Yeah, brief. Fantastic, awesome. And James, would you agree with that? Is there other ways that founders have grabbed your attention?
Yeah, so I actually dread warm intros to some extent because I feel sort of obliged to over-index on providing time back. It's really difficult. We get a lot of emails in. I like to reply to everything. I'm inbox zero, so I will reply to everything. And the best way to really pique the interest is to send a deck, again, as Horia said, with really short, concise, this is why I'm getting in touch with you specifically, that's the best way. and it's very off-putting if it's completely wrong. So it's best if it's just very, very targeted to us, and I prefer a direct approach, and there's no shortcut with the pitch deck. I have to see a pitch deck. So for me, that's really important.
Yeah.
But other ways, you know, I had Loom recently in my LinkedIn inbox, and I took a meeting. So there are other ways.
That's a really interesting, because I've been asked that a few times, and I've seen some founders use that with great effect. Is either a personalized Loom message, or a very quick kind of teaser pitch recorded via Loom. So that's worked for you. That's kind of grabbed your attention as being something a bit different.
It did. It had a very strong kind of social impact element, which also helped, because to help. We're not investing, but I wanted to help. So that was the reason why I was, took that one to a call.
Yeah, awesome. Doran, what are your thoughts? Is it the same thing, or is there anything you've seen that's really grabbed your attention?
I think I have a slightly different angle, and it might be because I come from the family office type of world, so that might be why. But I would say that if you have someone who could introduce you to the investor that you're trying to approach, that can often, in my own experience, be an efficient way. And the reason I'm saying that is because you've got so many entrepreneurs who are trying to reach out to these investors that you're trying to reach out to. And if you don't want to, if you want to get to the door and get to that investor, I think both for the investor, it's an opportunity to through that referral, through that person that wants to introduce, to verify, that's actually relevant. And if it is, then fine, like thumbs up, make the introduction. And if not, then not waste anybody's time. And also for me personally, and for us in general, for a fund, it's a way also, it just gives us an initial way of doing background checks on the entrepreneur, which is often very important. It's something that specifically for early stage entrepreneurs who haven't had previous exits, and we know very little about. If we don't have any connections, and if we don't share anyone in common, then it can be quite hard to put that trust with the entrepreneur. So that's why I'm generally for that approach. Otherwise, if you don't have any connections, I would definitely say to keep it concise. Take a direct approach, whether it's through LinkedIn or if you have the investor's email, and just have a teaser, as James suggested. Have a teaser, keep it short to the point. Have your milestones in there. Have all of the data that you think that would generate interest from the investor, and this way, he'll get back to you, yes or no. It just makes it easier for everybody.
Yeah, no, that's I think from the investors that I speak to, those are the two preferred methods: a very concise, direct, researched introduction, or a warm introduction from someone that they seem to always come up as the two best approaches. And for those of you who have seen my How to Make Investors Love You talk, it's all about kind of those strategies, and also it's a numbers game. So I've got this 30-10-2-1 rule. For every one investor that you're going to secure, you need to be reaching out to 30 on average. It's a numbers game. You need to start growing that network of potential investors now. Awesome. So Dan, is there anything, because you're on the other side of you're on both sides of the fence. You're both an entrepreneur and founder who's successfully raised investment, but also an investor yourself. So is there any insights you could share?
Yeah, I think I learned more through being a founder. We raised just over £1 million on a $7.5 million valuation on a concept. We didn't have a product at the time or any customers. And I think what I would say now is you got to know your audience. If you're pitching to VCs, I wonder, is that a bit of a different approach to if you're approaching angels? For angels, I think it's got to be highly personalized. You can generally find out who they've invested in before. Look on Crunchbase, look on LinkedIn. And if there's an alignment between their investment record and your business, then straight away there's some pretty solid clues there. And we've talked about being personalized. You should absolutely be name dropping. I see you've invested in this company and that company. I think there's a great complementary thing that we're doing, or we're similar because of this. Really do sort of advertise yourself as to how you might be a comfortable fit into their portfolio. What I would also say, we've talked about direct, being introduced by someone else or not. I would absolutely do that as well. You can reach out to someone directly, having already arranged someone to do that warm intro, and you can drop that in. You can say, oh, I've spoken to so-and-so, I know them, they said that they'd give us an intro next week. Always try to get ahead of that curve. And it might well be that they're going to open up that dialogue with you before they've received a warm intro from someone. But what I really am a big fan of is highly personalized. If I feel that a message has been sent to me that's copied, pasted, and sent 100 times that day, there's almost sort of barriers that go up, I think we all as humans sort of sign a bit of a social contract with each other, that when someone's making an appeal to you, they know you a little bit, there's some sort of relationship they're trying to build. Even if it's a negative answer, you feel a bit more compelled to respond to them if they've made an effort to research you a bit.
Yeah. I find it, I get these requests as well. I get these blanket emails sent to me about an investor. I don't have investor on my portfolio. I run a business that helps people seek investment, but I don't put myself down as an angel investor. And even I get those copy and pasted blanket emails, will you invest in my company, just because I'm in some way connected with the industry. And clearly they haven't done their research, and I'm one of hundreds of people they've sent that to that day on the off chance. And that blanket approach just is never going to work. I'd like to flip it on the head, on this question on its head. And Adrian has asked, beyond that getting approached and people reaching out to you, do you favor any methods for actively sourcing deal flow yourself? Or is it all, there's so much demand that it all just comes to you? Or do you need to go out and find some deal flow sometimes? And if so, what's your methods for doing that? Should we start with Dan and work backwards? Let's start with Dan and work backwards.
Yeah. I mean, I think with very popular companies, there is this fear of missing out. A lot of popular companies are oversubscribed, and quite often, as an angel, I've really got to sell myself to say that, well, this isn't just dumb money coming in. I think I can help you with network effect, or this, that, or the other. You sort of want to give a bit of other value beyond the money. And they're often the best companies that you've got to work for to get involved with. So it's always a good idea to be checking out the different accelerator programs and different pitch events. Like James, you were just saying, it's as an entrepreneur, it's a bit of a numbers game, and you've got that sort of ratio, as it is for angels as well. If you're turning up to these pitch events and listening in, there's going to be other interest as well, I imagine, or typically. So I think with companies that I'm interested in and would like to put money into, I would say that I'm probably successful 80% of the time. There's certainly the occasional one that they're just oversubscribed, and apart from dumb money, it's hard for me to add any additional value there.
What do you think, Doran? What's your, other than deals coming to you, how do you actively seek founders?
So other than deals coming to us, I think similar to what Dan just said. So in terms of like accelerators, we're connected to a bunch of accelerators to try and source potential deals from those. They often have brilliant quality companies who they've obviously vetted and worked with for some time. So that's always a great way for us. Other than that, shared deal flow is a big one as well. We share deal flow with a large number of family offices and VCs, and likewise they share their deal flow with us, and equally our portfolios, of course. So if we have a portfolio company that has a follow-on round, and let's just assume that we're not taking the entire round on the follow-on, then we'll happily share that with some of our co-investors. And likewise for our co-investors, this is very typical to happen as well. Yeah, other than that, trying to think what other ways. I had another one in mind, but I can't really think of it now. Yeah.
What about you, James? Is there any particular places you go to seek the best investment deals?
Well, we're probably slightly unconventional, which is probably about half of our deals will be sourced by us rather than inbound, and that's because of the stage we're investing in, which is kind of pre-A. So we're kind of almost finding companies that have already done their seed and negotiating our way into the business before their Series A. So that's one thing that we have to do, and the way that we go about that is through various channels. Predominantly, we reach out to the founders on LinkedIn once we've come across the business. We do have a small scouting network as well that bring in deals. But really, we like products that we find that we can get obsessed by and then try and negotiate our way into a round. So that's slightly unconventional, I think. But, we are still investing in companies that come to us. And we, as partners, we will have our email on our LinkedIn. So people can just email us out the blue, and half of our portfolio will be filled with businesses that we didn't know before starting the fund. So yeah, I mean, we're very active, and I think increasingly investors are probably going to need to be proactively getting into the best deals and not just waiting for inbound.
Yeah, fantastic. And Horia, anything you'd like to add? Any other tactics you use to find deal flow?
I think very, very similar to James. Our approach is pretty much being out there and trying to find opportunities ourselves. So I think probably 70 to 75% of the opportunities that we actually invest in are just us reaching out and trying to understand what's happening in the market. So from that point of view, and I think that's kind of happening in the wider VC industry, is a lot of VCs are thinking, how can we use data to find successful companies or early signals that give you an indication of that something is going to be interesting. So whether I would say there's a myriad of tools out there, and if you put on the research, you can really understand that founders are also aware of this, that in this world that we live now, and with COVID, it's a very good way to promote yourself or have some signals that investors can look at, right? So if you look at products like Product Hunt or things on AngelList or Hacker News, I would say that's very good ways to kind of get your eyes in front of the investors, and we tend to do that quite a bit, right? So we tend to look at specific metrics, how specific growths of employees within companies are looking like. So we're trying to do that much more, just because we know that we can have a sort of a more structured way of looking out there. So I would say data is kind of one of the upcoming things, and things that we've definitely incorporated in our process. And otherwise, probably the second thing, and I would say also is very important, is we also get a lot of approaches from just founders. So founders that we speak to, we keep in touch, and we know that they're fairly well connected, and they act as operators in the industry. So we trust those introductions from them probably the most, right? Because they know each other, they're friends, they know the industry in some ways even better than us at some point. So I think this is also kind of a channel that we use a lot. Just the founders that we speak to, for some reason, even if we pass them to them and we still kind of keep the relationship there, they're so valuable because we can give the advice going forward. They can help us, identify and find great founders afterwards. So those are would be my two takes.
Yeah, that is really interesting from James and Horia, because it's something that I talk about a lot in some of my talks around the power of actually building that personal brand and actually getting yourself out there and really hitting LinkedIn and telling your story, telling your entrepreneurial journey. The more you can get out there, the more likely when you're actively looking for those founders, you're going to come across them. And then the best founders end up having investors approach them rather than the other way around. And if you can manufacture that by getting your personal brand out there and telling your story, I think that's all part, all of these things, you do all of this stuff, you're absolutely going to smash it. Cool. So let's move on now. Doran, I'm going to come to you because there was a lot of interest from the questions in terms of your stance with impact investing. It's obviously quite a popular area and a contemporary area right now. So we've got a question here from Sahil, who wants to specifically ask you how your investment process differs compared to other investors when you're considering like the impact of your investments.
Yeah. So with impact investment opportunities, you'll be required to present some measurable, traceable, data for the impact that your business is having on society and the environment. So this will be looked at with a great deal of depth. So it's a core part of the strategy for the investment itself. And it's a way of proving your product at the same time as being, market fit, and the greater the impact, the greater the opportunity size. So that's really what we're essentially looking at, is is quantifying the impact. And if you're able to prove, and able to measure the impact that your business, your products, your service is having on society and the environment, that will be key. Whether that's how much emissions you reduce, or how many people are affected by this, those will be the things. And obviously, we are using some ESG material to incorporate into our strategy, and in order to assess in the investment value, your risk and return potential.
So as well as the standard kind of investment metrics that you might be looking at, you've got those, you want to see metrics, numbers, not just a vision for creating an impact, but actually what's going to be achieved in terms of numbers, savings, whatever it may be on the environment or society. Or
exactly, because it's a fine line between managing risk and managing impact, and measuring is the key between the two.
Fantastic, awesome. Do any of the other investors here want to sort of come in on the types of impacts that they're looking for, either financial impacts or environmental or social impacts? Just raise a hand, I'll bring you in on this question if you've got something you want to add to the whole impact angle. Yeah, James, go ahead.
Yeah, I haven't got anything too revolutionary to add, but it always helps when there's a sort of tech for good angle, for sure. And one way that impact is a sort of measurable thing is kind of B Corp status, which is increasingly picking up steam. So if you're a company that is really focused on being impact, they should look at the B Corp scheme. And if they get registered as that, it's kind of a symbol they can add to all their materials that makes it very easy for investors to clock that as an impact investment. So certainly something for people to look out for, and it's something we look out for.
And do you tend to, and this is sort of an open question to all of you, do you tend to have a certain percentage of your portfolio that you want to be impact investments, or is it kind of when you see them and they make financial sense and have an impact, it's kind of an extra tick on the ticket towards that business? How does that compare when you see an impact investment come across your desk versus a more traditional investment? Let's go to Dan. Is that anything? Yeah.
I think my view, to be fair, probably isn't the most popular view, but it doesn't really have any impact at all with me. I tend to have quite a strict sort of definition in terms of sort of charitable stuff versus if I'm going to invest in a business and they're there to make money, then I like to see them drive efficiencies from companies and to solve problems. But all those problems are around process or governance or something. I don't. It's not like have a big fund where I'm doing dozens of investments a year. So I tend to be very sort of clinical in saying if I'm investing in a company and they're there to make money, then that's what I'll work with them on. And my own background, it doesn't really lend itself well, particularly to impact investing either.
Awesome, thank you. And Horia, is there a particular angle that global founders take on impact investments?
Yes, I would say that we don't generally like looking at specific sectors. We don't let's say allocate. We want to do a certain amount of investments within a certain amount of time frame in the sector. But I would say that the impact, sustainability, climate approach is something that it's new to us, and we're kind of dipping our toes now, and it's pretty fun. We've made a few investments already. Most of them have been in the US, and mostly related to climate offsetting. And I think this is kind of one of the most most prominent topics nowadays in terms of companies being founded and ways to monetize on that. But I think what is most interesting to me when I look at a business like this, it's just the community and how you build a community around the product, right? I would say that you can have very smart ways into calculating the offset and making it easy for the consumer to be integrated, to be on your phone and connect with your bank. But I think that's kind of the most value you can create, and something that also an investor can sort of relate to, get from other industries, is a power of the community that you create, right? So I think getting people to join a specific cause and kind of seeing that activity, seeing that engagement grow throughout time, I think that's kind of the most important thing. It's, I would say, one of the most attractive things that we look when we look at impact of climate or sustainability.
Fantastic, awesome. So got a really interesting question.
Can I just add one thing to that?
Yeah.
So I think that something that for us at AdSafe, so we try to contribute a substantial amount of our fund capital towards impact investment, and what we've noticed as we've started our journey in impact investments is that there is this misconception that impact and revenue are two separate things, and like Dan said, I guess he hasn't had much exposure, and I've known and seen many others who haven't. But there's this misconception around revenue, charity, and impact businesses. But really, what we've seen with our portfolio companies so far, and the reason that we're encouraged to continue on that is that actually when you think about the magnitude of the problem and the amount of lives that are affected by the problem that the business or the product or service is trying to solve, is directly actually correlated to the value that it can create. If you're talking about something which touches billions of people across the planet, then you're evidently talking about something which also has at the same time the opportunity, the same size opportunity in terms of revenues, right? And that's something which I think a lot of from what I've seen, at least, a lot of investors are starting to notice, and the fact that those two things can go hand in hand. You can have that great impact. You can also make a great return on your investment. Is what is encouraging more and more investors to go into impact investing.
Yeah, it's a common misunderstanding, and but I also think there is on the founders to communicate both. It can be quite difficult. Sometimes they focus so much on the impact, it's hard for an investor to see where the return's coming from. And equally, if you focus too much on the return, you can't see the impact. And if you've only got a few minutes to pitch, it can be quite tricky. So what would your advice be, Doran, to founders in that situation where it's like, do we go on the commercial and the impact? We've only got a few minutes to, you want that concise introduction. Where should they start? What would your advice be?
I think that their focus should be on showing how they go hand in hand. So I think their focus should be on showing the business, focusing on the product, focusing on the key unit economics, focusing on the numbers as you would with any other business, and then at the same time, show on the other side, all the all the positive impact that the product or service is having in a measurable and quantifiable manner. That's what I would suggest.
Awesome, brilliant, thank you. So yeah, we've got another question here from Virel. I hope I've pronounced your name right. He would like to know a little bit more about the importance of traction, because he's gone through 2 funding rounds previously, one at an idea stage, one at a prototype stage in the past, and he feels that it's quite rare today to raise money at that stage, and that there's been a shift towards kind of revenue generating traction led businesses. So he's wondering what your take is on that. Why has that change happened? Has that change happened, or is it just a myth? That we really, I mean, Dan, I'd like to come to you on this, because you, in your first response, you talked about how you raised investment for a pre-revenue prototype stage business. So it'd be interesting to get your take on that.
Yeah, this is really subjective. I think this is a great question. You know, my view is that West Coast US, there's a lot more investors in there who they basically have a better appetite to get in at an earlier stage, at a pre-revenue, pre-traction stage. UK, Europe, I think we're catching up, but it's still quite rare to raise money from investors beyond friends and families, a bit beyond crowd cube type stuff. If you're going to go out to investors, then it's much more common to get traction. But we've got to be careful how you define traction. You know, it's very easy to say, well, that's obviously about customer engagement and revenue, and that certainly is a big part of it. But what about everything else? Who are the advisors you've got? Who's the team you're working with? Have you got any development in terms of prototyping? Any engagement with feedback loops with the testers? So, you know, even without revenue, you can still come across with, this is not a concept. We've practiced this, we've rehearsed this, we've taken it to market for feedback. We've got this, you know, vortex of people who are getting involved in the business. And you can really start to position yourselves as a company who's making significant progress before a pound revenue has come in through the door. So it's not easy to achieve, and I think the sort of UK outlook or European outlook is confidence is gained through revenue. If you don't have revenue, then where do you go? You've got to be building all these other blocks to put yourself in as best position as possible.
Fantastic, thank you. James, so we'll come to you on this one. What's your take on traction, and whether it's, you know, is that the trend, or are we starting to see more and more investments in pre-revenue, or earlier stage companies?
It really depends on sector. There are some sectors where you can't expect traction in the sort of traditional sense. What we always look for, I mean, we're a post-revenue generating investor, so we can't invest in anything pre-revenue, but when I'm wearing my angel hat, when I think of traction, I like to see something, whether it's a wait list or a community or something they're building, to kind of show a growth mindset and show that they've gone out and spoken to customers or enterprise clients. In some way, they've shown that they have a willingness to sell this product, and they've thought about the pricing and the business model. So that's what I'd say on that. I think the other realization is that funds can afford to go later. There are so many deals out there that we don't have to go pre-seed if we don't want to, kind of thing. So, as you know, increasingly funds navigate towards Series A, and then new funds come in at seed, and then we see a cycle kind of repeating. But that's where the SEIS and EIS schemes are particularly good in the UK, and angel funding, you know, is very prevalent in the UK. So, and we're going to see more and more of that now that we've got over 80 unicorns. We're going to have angel investors who have been on scale-up journeys and are looking to reinvest at early stage with that experience and capital that they've gained along the way. So, yeah, I mean, traction's always beneficial, but it can come in lots of different formats.
Yeah, I think it's a really important point that you and Dan have just raised. Is traction can also mean validation. I often use both and both are often used interchangeably, but people think traction is revenue. There's also the validation that we have a customer waiting list. We've confirmed that people want this product, so once it's available on the market. But it's, you know, we've got industry professionals who are all waiting to support this product and want to push that out to their networks or whatever it may be. I think the earlier you are and the more evidence you can give and more proof you can give to an angel investor that it's something that people want, and that there is a market for it, and you've validated the problem, the solution, the product market fit, the better you're going to. So it's proof. Just provide as much proof as possible. That proof doesn't have to be cash in the bank by the sounds of what you're both saying. Would you agree, Horia?
Yes, I do. I think Dan's point on, you know, US versus Europe is the most important and very topical nowadays, because, for example, we invest a lot into revenue businesses, and at least I would say in the past few months, or kind of the end of 2020, we've seen a wave of US funds coming into Europe and, you know, just investing pre-revenue, just with an idea, giving very big valuations. So I think this sort of, you know, entrance from a lot of the US players into the European market is going to force a lot of the EU funds to really think about, you know, caring a bit less or compromising a bit on those metrics and needing to see something and, you know, looking at the story. Because in the end, I would say, you know, the first two rounds or the first round, it's really about being able to create a story around your company and what you're going to build, how the vision is going to look like. So I can imagine 2021 is going to look more and more towards that, more pre-revenue investing. As more and more funds are also starting to look earlier, right? I think the competition is getting much stiffer. So, you know, we as traditionally more, you know, pre-seed and seed, we're probably going to start doing more angel pre-seed type checks. Series A investors are going to move and do more investments towards seed. So I think we're kind of seeing a small shift there with the US players coming in. But, you know, to sum up and to answer the question, I think traction is important, but it's just one piece of the puzzle.
Yeah, awesome. I'm loving that James has got his own deal sourcing chat going on in the chat, telling everyone which funds they need to look at. Anyone looking for a particular type of fund, James is your man. He knows them all. Doran.
I'm just trying to be helpful.
Doran, presumably you've got a similar take on traction.
Yeah, absolutely. So I think, you know, as you've said before, James, you know, traction is extremely important. It validates your business, your idea, and it reduces risk from an investor's perspective, which is extremely important, particularly for an early stage or entrepreneur, or, you know, for a first-time entrepreneur. You know, with no successful exits prior to this one, you know, it will be extremely important to see some traction. So I think otherwise, if you don't have any traction, what's going to be really important is to have a, you know, strategic in on the industry that you're targeting, the market that you're targeting, you know, or some sort of angle, you know, whether it's your prior experience from that industry that you're trying to tackle, and your connections within that industry. Those will be really important. I mean, if you are a serial entrepreneur, you know, I'm sure that, you know, everybody will overlook your story, your experience. You know, I mean, everybody will already know about your story and your experience, and, you know, there won't be any need to put too much focus, and then people will even overlook your idea. I mean, if you're Elon Musk, people will just put money behind you, right? Whereas if you're a first-time entrepreneur, or you haven't had any successful exits prior to this, you know, traction is going to be extremely important, or any other strategic angle. Yeah, I mean, even pipeline, if you have.
Yeah. So the advice is kind of, if you don't have kind of much in the way of traction, it's that your own kind of insights, your own leverage of your network that's going to be able to deliver traction quite quickly, because you know certain people, or you've been in the industry for the however many years, and you've got the right connections to make this happen. Is that seems to be what you're suggesting?
Yeah, exactly. Yeah. And bottom line is just like, you know, traction minimizes risk from an investor's perspective, and I think those two have to, you know, entrepreneurs should start how they're linked.
Yeah. Absolutely. Awesome.
And just one more sort of point on that, and actually sort of responding to something that's going on in the chat here. I think Adele brought up something around level of traction. But someone else was mentioning, I can't remember if it was James or Horia, but you've got to look at the industry as well. If I'm looking at a consumer-based business, then I think in my mind, I do have different traction requirements for that versus something that might be doing deep tech, something a lot more complex, B2B stuff. In consumer, it should be a lot easier because you're looking at obtaining a much wider group of users. You should have some traction with the user base and with a good path to revenue, even if you're sitting at zero revenue. Skype's a good story of that. It had at times sort of Series A. I can't remember how much was raised, but had not only a lot of users, but they were growing exponentially. The network effect there was extremely powerful in the very early days. And there was no idea around how to turn that into something that could make money. The concept of being able to put credit on and call regular phones wasn't in the product roadmap at that stage, but the traction was there, and you could see the trajectory that they were on. So on a sort of consumer side, I have one view around, traction has to be there in just acquiring that community or that user base. With B2B, depends what it is. If it's deep tech, that takes a lot of funding before you've even got a prototype.
Fantastic, awesome. This is a really great question from Amit. They ask, what's the most common or consistent reason for not investing in a business? So the one reason that comes up the most for you to say no to a founder. We'll start with Horia.
It's an interesting question. I'd say it's either one of the two, the team and the fact that maybe they're not the right, there's no fit with the market and the experience, or the timing. A lot of the times there are really interesting ideas, but the timing in the market is not the right one. So they eventually, they build great products. They think they're going to get investment, but the timing is not right. And that timing might be, 6 months from now, 1 year from now, maybe 5, right? So I think that is something that is more art than science to finesse it. But I would say, these two, timing and team, is usually the most common ones.
And that team almost goes back to Doran's point on, if you don't have traction, you need to have that team that has experience or have connections in the industry to actually make this happen. So all these dots start to get connected when you're analyzing a deal. Cool. James, what's your take on that?
There are the obvious ones, like it being off theme, so wrong sector, quite a quick no stage, obviously. I'd say that we like stuff where it's kind of easy to communicate, and I don't mean that we don't invest in complex things. It's really that the founder is capable of communicating it easily and almost enables us to share with our team very easily, because it's sales ultimately. And if they can communicate effectively what they're doing, why they're different, why it's interesting, then they can probably go and sell it as well. So we have companies that sometimes kind of linger in our deal flow for quite a long time. And then eventually one of the partners will just turn around and just say, look, we're not loving it, it's over. And that's because we're just not getting excited about it. The founder's not engaging with us in the right way. We're just not getting the right feel. So the sort of recommendation would be, once you're in with a VC, more touch points are good, but they don't have to be Zoom calls. It can be a WhatsApp message or a, hey, we had a good bit of news today. What's the next step? It can be really small things. So show that you're engaged, and also just like really clear, concise communication and great documentation. Like we actually like to see a data room almost as soon as possible once we've had a call and shown a bit of interest, because we're going to do our due diligence, and we're not going to share it with anyone. You don't need to worry about that as a founder. It's so that you can help us get excited about it, really. And I'd say that's where a lot of founders drop off in the process, is not really helping us to get excited about it, which I know sounds a bit ridiculous.
Being able to pitch the vision and get you engaged emotionally as well as with the numbers and everything.
Yeah, and I also just that kind of that reason about if it does work, imagine what it would look like. So, I mean, I remember one of the early investors in Airbnb, lots of people were saying it won't work because X, Y, and Z. And then someone just turned around and went, well, what if it does work? And that just kind of changed the narrative.
Yeah.
And so no company is perfect. But if you can give one of the partners or like the champion who's running the deal that kind of strap line of, but what if it does work? This is the potential return. Because as investors, we can accept that some will make losses or will go to zero, but we're looking for 10, 50, 100x return type businesses. So if you can give us an easy narrative of why it has the potential to do that, that goes a really long way.
And you mentioned a data room. Can you just explain what that is and what people you would expect to see in that for those on this session that haven't heard of that term before?
Yeah, sure. So, I mean, obviously, a bit like pitch decks, they come in all shapes and sizes. But really, it's about like core documentation. So things that it might include are shareholder agreements, articles of association. If it's an EIS company, it would have your EIS assurance form. It probably also have all your employment contracts with your founders and staff. It will probably have a cap table document to show who the shareholders are, what stakes they've got. There's probably lots of things I've missed, guys, so please chime in with other things. It's basically a really simple rundown of all the documents that we would expect to look over ahead of an investment. Financials, obviously, would be one that I've missed.
Yeah.
So yeah, obviously you want to share that once you're comfortable with the investor. I wouldn't just share it to someone willy-nilly through LinkedIn that you've never met or spoken to. But certainly as you're engaging in the process, it's a really important part of it. And it's something that I didn't know about when I first started a company, and very quickly realised it was important to the fundraising process.
And Richard Steele here has done a plug for Seed Legals, who can help with the data room documents on the chat there. We like Seed Legals; they're a close partner of ours. They're great. Awesome. Doran, what's your most common reason for not investing in a business?
So team and timing is a big one, as Horia previously mentioned. Other than that, I'd say one of the big ones for us is too big a gap between the vision, the ambition, and the business plan of the entrepreneur. Meaning there's no clear execution plan or reassurance that that plan is going to be executed to live up to the standards of the vision and the ambition that the entrepreneur has set. And sometimes it also comes down to just, I think one that happens often is we get opportunities that, we get businesses and ideas that are just too similar to other businesses, which as James explained, for the majority of investors, or for many at least, it does not present the opportunity or the reason that investors try to tap into the to venture capital opportunities. We were not looking for a 2x. You're looking for 100x, and I think that and that's why you won't be. In our case at least, we won't be looking much at opportunities which are within an area that has already matured, or already been tapped by so many. So if you're just trying to copy another business model and try to have an add-on or take a slightly different angle, it has to be a very strong add-on or a very strong angle for us to be for us to look at.
Awesome, thank you. And Dan, what's your biggest reason for saying no?
So, well, first of all, I think I'll start from the perspective that this is saying no to companies where I've initially had an interest in. So I might have seen their pitch deck or seen their vision statement or something that's got me interested. And thereafter, I would probably say no to still a lot of them. I don't know, 4/5 of them. And when you think of it like that, the business idea, the concept they've got is only perhaps 20% of getting someone over the line to invest. The rest is, we've talked about the team. Is it the right team, the right founder? Do they have the gravitas to make an impact into that arena. You know, if someone's you know, just hasn't got the experience, it's more of an academic idea, then you know, it might be a great idea, but if it hasn't got the right people in the team, if they haven't got the right connections in the industry, then it becomes a lot tougher. So the way I look at, you know, once I've got initial interest in a pitch deck, that's what it is at that stage, when I engage with the founders, I treat it a bit like an interview. Like, you know, almost like, let's assume I like the concept. We've now got to look at a whole load of other things. Are you any good at managing a team? How are you going to do your recruitment? Who do you know in the industry who's going to help you along? And there becomes a whole load of other questions, different verticals, if you like, that they've really got to pass the grade on. So, you know, a great idea, it's just not enough anymore. And that certainly, no one should take that as a bad bit of news. There's plenty of people who can help. You know, you should know people in the industry that you're going into. You know, there's a lot of people who are happy to get involved in an advisory capacity. Depends how close you are with them. But I find that some advisors who might not be professional advisors, but they are in the industry and can add a lot of influence to your success or failure. Those sorts of people are quite often happy to do something for free because they're in the industry, they understand it, and they like to help out. This is something a little bit different. A lot of people like to get involved in startups now. It's you know, so what if they treat it a bit like a hobby? But you know, choosing and selecting your advisors and your team is critically important. It's as important, if not, I would say, more important than the business concept you're looking to scale.
Fantastic, thank you. So we're coming to the end. So I've got one final question for you all that was submitted by David Horn, and this is pertinent to how we started the session today. So he says it's very clear, the evidence is very clear that female and diverse entrepreneurs are less successful than white male entrepreneurs in securing funding. So what's you and your fund's view on how best to level that playing field? What should the industry be doing to try and level the playing field for female and diverse founders? Let's start with Horia.
So I would say, you know, the industry is definitely moving towards more diversity and women founder funding. And we've kind of seen this trend happen in the last 2 years. We personally, as a fund, have invested more into diversity and women-led founders. So I think last year we've only invested in 7 of them, but we try to increase those numbers this year and the next one. And a lot of the niche or where we found a lot of success was a lot on the D2C side. So probably the most successful D2C companies that we have in our portfolio are actually women founded. So companies like Blue Land or Away or Popcorn or Fast. So we're trying to encourage that by actively, you know, looking into the market and giving those funding, but we're also kind of participating more into events that are happening in the industry. And I think there's much more awareness happening nowadays. I'm taking part into female founders office hours. I'm trying to be part of communities where I can hear and understand and kind of help on the mentoring, on the pitching. I don't think that I can say that I agree with the fact that, you know, women entrepreneurs are less successful in securing funding. It's just, I think that the numbers haven't been supported by that yet. I just think it's a question of getting more comfortable and being more bold in for that approach, and not trying to see it as a disadvantage, but actually look at the ways you can shine in front of you know, compared to somebody who is, you know, white or male, things like that. So I'm fairly bullish on how things are going to look like, and hopefully you know, we'll get to see a lot of activity in the industry as well in the coming years.
Thank you, Horia. James, what's your take on that? What should the industry, what should investors be doing to level the playing field?
Well, so the way we've structured our deal flow and deal process is that it should be a level playing field for everyone, because we always start with a pitch deck. Anyone can email us. So at the entry level, it's pretty level. We have female advisors as well. And one of the things we do is if we have a female founder, our initial conversation, our initial call will often include one of our female advisors, because we want to break down the kind of having to speak to a panel of men as the first entry point as well. So that's one couple of things we're doing. I mean, one thing we did, we actually put a bit of a call out for more female founders to get in touch with us, and we didn't get a great response. And so we need to rethink about how we engage with female founders. And I know there's been some very successful female office hours kind of sessions, which have done really well. And so we're actively speaking to people that run those so that we can participate as well. But yeah, I think that, you know, the accessibility is number one thing, just to open the level playing field for everyone. And then trying to bring along advisors and partners that that feel very familiar to all founders, so that people can feel confident in pitching us and feel that there is someone who's sort of on their side or has gone through the similar things. So yeah, I'd say, but there's always more that can be done. And hopefully, there was a question about what's a good fund for female founders. Hopefully every fund at the moment, so that it shouldn't be a problem. It should hopefully be a benefit. And so be confident in reaching out and pitching, and yeah, just go for it. All funds are looking for more diversity when it comes to funds, portfolio company founders structure.
Fantastic, thank you, James. Doran, what are you doing at Tay Ventures with regards to this?
So I'll start by saying something which I'm not sure if everybody is familiar with, but something that advocates when we're trying to increase our female deal flow in terms of entrepreneurs and businesses. For every 10 male entrepreneurs in the UK, there are less than 5 female entrepreneurs, I believe. And so I would say that the first thing to do is to encourage more women to chase their ideas and their dreams to begin with. And I think to do that, there needs to be a conscious effort made. Like James said, hopefully every fund will be the ideal fund for a female entrepreneur. But yeah, I think it's around consciousness, and awareness. So I think we need to bring more awareness around it and make more of a conscious effort to bring those entrepreneurs who haven't really shown themselves yet. Because when I look at my deal flow in general as well, I can actually see that data is actually backed by it, because we tend to have a lot more male entrepreneurs in our deal flow than female. Doesn't mean that we don't have any female entrepreneurs in our deal flow. But yeah, I would say that, and I think a great way that that some have done it is by creating female focused accelerators, for example, a female entrepreneur focused accelerator. So that's been a great way. But for us, it's really just about trying to kind of get a level deal flow of both male and female entrepreneurs, and really looking out for it. So I think we need to make an active effort rather than just have a passive deal flow for female entrepreneurs.
Cool, awesome. And Dan, from an angel investment perspective, what's your take on leveling the playing field?
I mean, for me, it comes down to deal flow. I mean, James, you shared some of these questions that were submitted to you, and this is one I looked into. Of the last 20 pitches that have reached out to me, all of them were male. Over the last 40, I had 2 females, two out of 40. So there's just a huge disparity in the approaches that I get. We as a company, not on the angel side, but on OrgNet, one of my founding employees, Yekaterina, she's very active as a sort of free advisor, not charging equity or it's just a passion of hers to try and help fellow female entrepreneurs. And she helps very much with the sort of the signaling that a startup can do. So who are the founding team? How does the pitch deck look? Who should they be networking with? So she helps an awful lot with that. And she's looking for more businesses. If anyone wants help with that, then just feel free to reach out on LinkedIn. But going back to the question, for me, it's really all about deal flow. I statistically, I just get very, very few entrepreneurs reaching out to me for investment.
I'm muted and talking. There we go. Thanks a lot, guys. That brings us to the end. We've gone over time. We're past 4 o'clock. So I hope we've answered as many questions as we possibly could today. I hope you all got a lot from today's session. I know I certainly have, and by the looks of the chat, there's been a lot of activity going on and a lot of questions answered. Investors, if you want to put your LinkedIn or email addresses, or however you would recommend founders connect with you into the chat, that would be awesome. I think Doran, someone was saying they were struggling to find you on LinkedIn, but I found you easy enough. So I'm sure if they just type in your name, they should find you. But it's Tay Ventures.
I'll put it. Yes, at Tay Ventures. I'll add my LinkedIn to the chat.
Fantastic. Lovely. Well, thank you all for joining me. It's been an absolute pleasure to have you all here and hear your insights. And thank you so much for sharing those insights with our community, because it really adds so much value. Because for so many of our community, it's their first time raising investment. They've never done this before. So knowing what's happening on the other side of the table is so valuable to them. So thank you all very much for joining. As I mentioned, if you want to get the recording of this, if you missed some of the questions at the beginning where we were talking about the sort of red flags that investors have, what you need to be pitching to get their interest and get their attention, then check out the recording on YouTube. It will also be on our Facebook group, Investable Entrepreneur, and I'll post it on my LinkedIn profile, James Church, as well. So that's all from me, and thank you all much for coming, and we'll see you again at the next event in a couple of weeks' time, where I'll be talking you through our methodology for creating the perfect pitch. So check that out in a couple of weeks' time. But that's it from me. Bye.